30 life insurance exam terms you need to know in under 30 minutes. Question 1. Dividends paid by a mutual life insurance company are guaranteed, taxable income, considered a return of overcharged premium, only paid upon death. Life insurance dividends from a mutual company are generally not taxable because they are considered a return of excess premium. Question 2. A policy loan is available on which type of policy? Level term, decreasing term, whole life, accidental death. Whole life policies accumulate cash value, which the policy owner can borrow against through a policy loan. Question 3. Universal life insurance is characterized by fixed premiums and fixed death benefits, flexible premiums and adjustable death benefits, no cash value, mandatory investment choices. Universal life allows the policy owner to adjust the premium payments and the death benefit amount. Question 4. What is the main purpose of life insurance? To fund retirement, to protect against premature death, to pay for healthcare, to accumulate cash for vacations. Life insurance is primarily designed to provide financial protection to dependents in the event of the insured's premature death. Question 5. Who has the right to change the beneficiary? The insured, the policy owner, the current beneficiary, the insurer. The policy owner controls the policy and has the right to change the beneficiary, unless the designation is irrevocable. Question 6. If an insured misstates their age on the application, what will the insurer do at death? Deny the claim, pay the full face amount, adjust the benefit to what the premium would have purchased at the correct age, refund the premiums. Under the misstatement of age provision, the insurer adjusts the death benefit to the amount the premium paid would have purchased at the correct age. Question 7. What is the settlement option where the proceeds remain with the insurer and only earnings are paid? Interest only, fixed period, fixed amount, life income. Under the interest-only option, the insurer retains the principal and pays the earned interest to the beneficiary. Question 8. What type of term insurance has a face amount that reduces over time? Level term, increasing term, decreasing term, renewable term. Decreasing term insurance features a death benefit that decreases over time, often used to cover an amortizing debt like a mortgage. Question 9. The incontestability clause generally prevents an insurer from denying a claim due to misstatements after the policy has been in force for 6 months, 1 year, 2 years, 5 years. The incontestability clause prevents the insurer from contesting the validity of the policy after it has been in force for 2 years. Question 10. What does the grace period protect against? Unintentional lapse, fraud, misstatement of age, suicide. The grace period allows a certain number of days after the premium due date to pay the premium, protecting against unintentional policy lapse. Question 11. Annuities are designed to protect against dying too soon, outliving one's income, disability, medical expenses. While life insurance protects against dying too soon, annuities protect against outliving one's savings by providing guaranteed income. Question 12. The suicide clause typically excludes coverage for suicide committed within 1 year, 2 years, 5 years, 10 years. If the insured commits suicide within the first 2 years, the insurer only refunds the premiums paid. After 2 years, the full benefit is paid. Question 13. Which rider waives the premium if the insured becomes totally disabled? Accidental death, waiver of premium, payer benefit, cost of living. The waiver of premium rider waives future premiums if the insured becomes totally disabled according to the policy's definition. Question 14. When must insurable interest exist in life insurance? at the time of application, at the time of death, throughout the life of the policy. Insurable interest is not required. In life insurance, insurable interest must exist at the time of application, but it is not required at the time of death. Question 15. A viatical settlement involves selling a life insurance policy by an insured who is retiring, bankrupt, terminally ill, changing jobs. A viatical settlement allows a terminally ill insured to sell their policy to a third party for an immediate lump sum of cash. Question 16. What happens if the primary beneficiary dies before the insured? The death benefit is paid to the state. The death benefit is paid to the contingent beneficiary. The policy is cancelled. The premium is refunded. If the primary beneficiary predeceases the insured, the death benefit goes to the contingent, secondary, beneficiary. Question 17. Which policy provides permanent protection with a level premium? Term life, whole life, universal life, variable life. Whole life insurance provides permanent protection for the whole of life, from the date of issue to the date of the insured's death, provided premiums are paid. Question 18. Which document contains the entire contract? The policy and the application, the policy and the marketing materials, the application and the medical exam, the buyer's guide. The entire contract provision states that the policy and a copy of the application constitute the entire contract between the parties. Question 19. Which of the following is a non-forfeiture option? Waiver of premium, extended term, dividend accumulation, guaranteed insurability. Extended term is a non-forfeiture option that uses the cash value to purchase a term policy with the same face amount as the original policy. Question 20. In a variable life policy, who bears the investment risk? The insurer, the state guarantee fund, the policy owner, the federal government. Because the cash value is invested in separate accounts, the policy owner bears the investment risk in variable life insurance.